Okay, good morning. Today we are going to finish up Chapter 3. There's a lot in Chapter 3, so there really is a lot I can't cover in class. I can hit the high points. But yesterday I emailed out a list of videos for every homework problem step by step. So if you need more help, then when we hit the high points, that is there. So what we're going to do is we're going to spend the first 2/3 of class or so finishing up Chapter 3. And then we're going to spend the last third, we'll have question and answer about the exam. So any exam questions, thoughts, or anything like that, hold till the end. I'm going to open up the chat room, and I'm going to take questions from people in person and on the chat room. So we'll do exams towards the end of class. I have a big chunk saved for that. So we will have time to answer any and all questions about the exam. So with that, we're going to start. We have a question out Learning Catalytics right now. What is due this Saturday? So what's due this Saturday? The only thing that's due this Saturday is the Chapter 3 homework. There is a practice quiz that's available. It's a practice exam quiz. It's available. It's not due until before you take the exam, so you have more time to do it, and we'll talk more about that when we talk about the exam today. But the only thing that's due this Saturday is the Chapter 3 homework. Okay, so that practice exam quiz is due sometime before you take the exam. So I'm going to close that question in a few minutes. So if you're just joining us, you still have a little bit of time to answer that first question. Okay, so first up, we have an exam next week. You have to start your exam before 4 p.m. on Wednesday. You can take it any time that time frame. And again, we are going to save exam questions for the last roughly third of class. We do not have class next week, by the way. It's in your syllabus. I don't feel that it's good to ever start new material when you're taking an exam that week. So next week, your whole job is to take the exam. So we'll talk more about that the last bit of class. But we're going to dig right in. So we're going to start with kind of a review from Monday, and we were talking about adjusting entries. Adjusting entries are what we do at the end of the period to make sure our revenues and expenses are correct, our accounts reflect what really is. And there's 3 types of adjusting entries. And the reason I write this down on the slide is you don't have this slide in the PowerPoint. You kind of do. It's a review from Monday, and we will have 2 or 3 questions over this throughout the day today. So you need to have this written down. There's 3 types of adjusting entries. The first one are deferrals. Deferrals we covered on Monday, and then they're when we get cash before we earn the income or before we have the expense. So this is when someone pays us in advance to do something, or this is when we paid for a year's insurance in advance or something like that. So deferrals are one type of adjusting entry. Another type of adjusting entry that we're actually going to start today with is depreciation. Depreciation is, we're going to talk about it in a minute, but that's another category. And then third category, which we'll talk some today about, are accruals. Accruals are when we incur the expense, we earn the revenue before the cash comes in. So deferrals are cash before, and then accruals are cash later. Okay, so you should be able to recognize what the adjusting entries are, the 3 categories. So you need to know deferrals, depreciation, accruals. Those are the 3 categories. And then deferrals are where we get cash before the revenue is earned, before the expense is incurred. Accruals are when we earn the revenue or we have the expense before cash comes. So those are our 3 categories of adjusting entries, and we'll have questions on those coming up. But first we're going to talk about depreciation, then we're going to do the accruals, and then we're going to continue down the road with this, the rest of the chapter. Okay, So depreciation. Depreciation is one of the categories. So we did deferrals on Monday. Deferrals are unearned revenue. Deferrals are prepaid rent, prepaid insurance. So those are deferrals. We did those Monday. Now we're doing depreciation. So depreciation, we are doing just a broad brush overview of it. We are going to have a whole chapter covering this down the road, but right now we're just going to give the high points. Depreciation has to do with what's known as a plant asset. A plant asset is something, big ticket item, an expensive item that we're going to use in our business for more than a year. So it's things like land, buildings, furniture, equipment. It's not stuff we sell as part of our business. It's stuff that we use in our business. So depreciation is the process of allocating that cost to expense. Okay? Now, let's say we buy a building and we spend $500,000 on it today. And that building, we're going to use it for the next 20 years. So that $500,000 that we spend on the building, we don't want to have an expense on our income statement this year because it could eat up all our profits. And we say, well, that's not right because we're using the building over 20 years. So what we do with depreciation is we take the original cost of the building and spread it over the whole life that we're using it, so every period gets some building expense is what we're doing. Now, depreciation is the process of stretching that expense, allocating it over all the periods. We do that with all plant assets except not land. Okay? Land is never depreciated, and I just say that. You don't really absolutely need to know it in this chapter, but it's just one of those accounting things that I feel like I have to say. We never depreciate land because land's considered to not be used up. Land is still going to be there. The building can crumble, so we'll depreciate that, but the land is still physically going to be there. So depreciation means we're going to take the cost of this asset and spread it over the life. Yes?
The land depreciated, what if you sold?
Okay, we never depreciate land because land is still physically going to be there. If you have mineral rights to the land, that's actually a separate asset called natural resources, and natural resources are a separate thing. But the physical land itself is not. So if you have timber on it, that's a separate asset. If you have things in the ground, that's a separate asset. So good question. Okay, we'll just dig right in. So let's say we purchased equipment for $24,000. So what we're going to do when we purchase the equipment, this is not an adjusting entry here. This is just what's happening. When we purchase the equipment, we're getting an asset. We're going to debit equipment because an asset is increasing, and we're going to credit accounts payable because it told us we purchased equipment on account. Remember those magic words, on account, meaning that it's accounts payable or accounts receivable. Accounts receivable is our customers. Accounts payable is our vendors or suppliers. So that's what happens when we originally purchased the equipment. So this is not an adjusting entry. This is simply recording a transaction. So we're going to debit equipment. We're going to credit accounts payable. So what we see then in the accounts is we see that equipment has a debit balance of $24,000. Equipment is an asset, and accounts payable has a credit balance, and accounts payable is a liability. So this all makes sense at this point. We have an asset, we have a liability. Now, this equipment that we purchased is going to last us for more than a year. In fact, they tell us in the next slide that it's going to last 5 years. So the equipment cost is an asset, and we don't want to deduct that all on our income statement in year one because we're going to use it over 5 years. So what we're going to do is we're going to spread the cost of that asset over a 5-year period. So let's say that the equipment will remain useful for 5 years and then be worthless. Okay? So we're going to take the $24,000 cost and divide it by 5 years, and that gives us $48,000 per year of depreciation. By the way, the PowerPoints that you can download have these slides and much more detail on it, but these examples are in there, and there's a lot more words in there. So we have 24,000 divided by 5 years, 48,000 a year. Then, because I know in this exercise we're doing it for each month, I'm going to take the 48,000 per year and I'm going to divide it by 12 months, giving me $400 a month depreciation. Okay, so that's my depreciation. Okay, so now depreciation says we're going to take that $24,000 we spent for equipment, and we're basically going to have expense. We're going to show expense every single month of $400 a month. This is because we're using what's known as straight line depreciation, which you don't need to know until we get to that chapter, but I'm just saying there is a method behind what we're doing. Straight line just says, let's just take the amount and divide it over the whole period, and we take an equal amount each period. Now we have a whole chapter on this coming up, and you're probably saying, well, what can we do in a whole chapter? Well, when we do a whole chapter, we've got different ways we can divide it up, and there's all different kind of little twists. But for right now, we'll just take our equipment cost, divide it by the period, the life, and we'll get $400 a month. So now when we go to do an adjusting entry, this is the adjusting entry for June. So June, we want to recognize something called depreciation expense, which depreciation is one of the 3 categories of adjusting entries. So what we're going to do is we're going to debit depreciation expense, okay? And sometimes you'll see they put like equipment after it or building or whatever, but it's depreciation expense we're debiting. And then our credit, you would normally think, well, we'll credit equipment, except that we never touch the original cost account. What we do is we have a special account called accumulated depreciation. And accumulated depreciation will credit for $400. On the very next slide, I'm going to talk about what that account is. But that's, when you have a depreciation adjusting journal entry, it will always be this. It will always debit depreciation expense, always credit accumulated depreciation. So what's happening in our case to all the account balances is we originally had $24,000 in equipment. So what we're going to do is we're going to debit depreciation expense, credit accumulated depreciation, and note that depreciation has not touched that original asset. Okay, now, so our adjusting journal, we just take it on faith that we have this account called accumulated depreciation. So what is accumulated depreciation? Depreciation will never go in equipment account. It'll never go in the building account. It always goes in an account called accumulated depreciation. Accumulated depreciation is what's known as a contra asset. That means it belongs with the assets, but it's opposite of an asset. And this accumulated depreciation is the sum of all the depreciation over the life of the assets. So accumulated depreciation holds all the depreciation. So every month, in our example right here, every month accumulated depreciation is going to grow by $400. It's a contra asset, so it's the opposite. So our equipment is a debit balance. This has a credit balance. They are always shown together. We always have equipment followed by accumulated depreciation. So they're always shown together. So I said they are always shown together. So what we have is we have something called book value. It's also known as carrying value. And it's the original cost of the asset minus its accumulated depreciation. So what we're going to see in this example, the original cost is $24,000. Accumulated depreciation, because we've only had 1 month, is $400. The book value is $23,600. They're always shown together. You need to know that book value is original cost less accumulated depreciation. Okay, so accumulated depreciation holds all the depreciation expense over time. So it's an accumulating total. Okay, so what you need to know about depreciation entries, they involve plant assets. The depreciation adjusting entry always has to be depreciation expense debited and accumulated depreciation credited, and book value is original cost less accumulated depreciation. And then we're going to cover that in much more depth in a later chapter. But for now, that's a nice overview. What we're going to do now is we're going to do a couple questions. Okay? So the first question I've got is, which of the following is not one of the three basic categories of accounting adjustment? So those adjusting entries, we start, the slide that I said, write this down. Here's the three categories. Also, we had it from Monday, the three categories of adjusting entries. Which one of these is not an adjusting entry category? So there were three categories of adjusting entries on the slide where we said write this down. Which one of those is not on that slide? I'm going to close the question in about 10 seconds. Remember, we had deferrals, depreciation, accruals. That slide, which one of those is not on there? Deferrals, depreciation, accruals. Okay, expenses. It's deferrals, depreciation, accruals. Those are the three categories. Okay, and don't throw that note away yet, because write this down. Remember the first one, deferrals, cash is before the revenue or expense, and accruals, cash is after the revenue or expense. We're going to come back to that in a little bit. Okay, so now we move into accruals. So accruals are the third category. So we had deferrals, depreciation, and accruals. So accruals, we can have accrued expenses and we can have accrued revenues. With accrued expenses, the expense is recorded before the cash is paid. Again, the PowerPoint downloads in Blackboard have a lot more detail, so if you want more detail, you can dig into it there. Examples of accrued expenses would be salaries. So when you work at a company, typically you get paid a couple weeks after the end of the pay period, a week or two after. Until that happens, the company has wages payable or salaries payable to you until they get caught up. Interest is interest expense on a loan. We usually pay it for last month, so it's accrued until it's caught up. Taxes. Okay, so this is good. So when a company has a year, comes to the end of the year, December 31st comes and happens, their income is done for the year. They don't have to pay their taxes for a couple months. So until they pay their taxes, they have accrued taxes payable. Because they've earned the income, they have the liability, they just haven't paid it yet. So that would be taxes payable. Rent, if we pay our rent after the fact, it would be rent, it could be rent payable. So those are examples of accrued expenses. We can also have accrued revenues. Okay, so accrued expenses. We have basically for these examples for accrued expenses, you're going to have the word payable after each one. So you'll have salaries payable, interest payable, taxes payable, rent payable. They're a liability because we owe it because we've incurred it, we just haven't paid for it yet. Okay, we can also have accrued revenue. Accrued revenue means we've earned the revenue, they just haven't paid us yet. So examples, services performed. So this is a doctor's office. They do their thing, you leave, and then they bill the insurance company. That would be revenue services performed. Rent is if we're the landlord and our tenants pay us after the fact. That would be where we see rent here. Interest, this is where we have made a loan and someone owes us. So those are all examples of possible accrued revenues. With accrued revenues, we record the revenue, we've earned the revenue, but cash comes afterwards. We get paid for it later. So we work and we get paid later. So when you work for a company, you think about it, when you finish Friday, that's the last day of the pay period, when you finish Friday and you know you're going to get paid in 2 weeks, until you get paid, you have an accrued revenue. Okay? So there you go, accrued. Okay, so now this, I'm going back to the deferrals now. I just want to highlight the difference between accrued revenue, where we've earned it and then someone owes us, versus this is a deferral. Unearned revenue is a deferral. That's where we get the cash before we do it. So if someone were to pay you in advance, that's unearned revenue. Examples of this would be concerts. The artist that's performing the concert has unearned revenue until they perform the concert. Airlines have unearned revenue until the flight is made. Magazine subscriptions. Companies that sell a year's magazine subscription have unearned revenue until they've delivered all the issues. If you collect rent in advance, that would be unearned revenue. Something important to write down, if you don't know already, unearned revenue is a liability. It's a really weird account because it feels like it shouldn't be a liability, but unearned revenue is a liability. Okay, so unearned revenue is a liability. So we've got a lot of accounts, and we need to be able to tell what kind of account they are. Okay, so this is a deferral. I just wanted to contrast it with the accrual before. Accrual, we record the revenue, we earn the revenue, and then someone pays us. With unearned revenues, we get the cash, and then we have to perform. So it just depends if you get cash beforehand or afterwards. In your textbook and in the slides, there is a summary of a whole multitude of adjusting entries. We could go over adjusting entries for the next 2 hours, but there's a nice summary of those. It's Exhibit 3-6. It's in the textbook, but it's also on those PowerPoint slides you can download for Chapter 3. So that's a really nice overview to look at. I just wanted to highlight that. And then we have another terminology, and then we're going to do a couple questions. So an adjusted trial balance. So an adjusted trial balance, what that does is it shows all our accounts after all adjusting entries have been made. And this is what we use to do the financial statements, to prepare the financial statements. So what happens in the whole scheme of things is transactions happen at companies every day. So the transactions are recorded, journal entries are written, transactions are recorded, and then at the end of and then we post those to the accounts, and then at the end of the period, we do what's known as a trial balance. And we talked about that last week. A trial balance is a listing of all the accounts to make sure the debits equal the credits. That is the whole purpose of a trial balance. A trial balance is different from an adjusted trial balance. So a trial balance is done before we do adjusting entries. So we're at the end of December, for example. We've posted all of our transactions to the accounts. We've gotten the account balances. We put them in this trial balance, make sure the debits equal the credits, we're good. Then our next step is to do these adjusting entries we've been talking about. So we do all the adjusting entries, post those to the accounts, and then we prepare a new trial balance. And this new trial balance is called an adjusted trial balance. It's called an adjusted trial balance because we've done all the adjusting entries. And then the adjusted trial balance is what we use to prepare our financial statements. So trial balance and adjusted trial balances are two different things. Trial balance makes sure debits equal our credits. Adjusted trial balances like, oh, we're ready to go. We're almost done. Here's the balances for the financial statements. Okay, so we're going to do a couple questions here. Okay, first one, what type of account is prepaid rent? Prepaid rent is when we pay our rent to our landlord ahead of time. So we might pay 6 months of rent in advance. So what kind of account would that be? Okay, so right now about 37% of you have it right. So let's talk about prepaid rent. Prepaid rent is when we're paying our own rent 6 months in advance. So if I'm paying my own rent 6 months in advance, prepaid means in advance, so I'm paying it. So let's just say my rent's $1,000 a month and I'm paying $6,000 right now. So I'm paying, right now, let's say I'm paying for March for 6 months. Okay, so 6 months onto March. So March through August, I'm paying right now. I'm a company, I'm paying. So that goes into an account called prepaid rent. Now, let's eliminate the easy one. I can eliminate 2 answers right now without knowing anything about it. Do I have a liability for that? No, there's no liability, right? I've just paid it way in advance. So it cannot be a liability. Okay, is this revenue to me when I pay my rent? No, it can't be revenue. Okay, so we know it can't be a liability. It can't be revenue without even knowing anything about this. So then we get down to an asset or an expense, and let's talk about the difference between those two. An asset is something that has future economic benefit to me. Do I have future benefit that I know that I can occupy this space each month for the next 6 months? It sure seems like it to me. An expense says, I've used this up. I just used this all up. No, I haven't used it yet. Time hasn't gone by. So prepaid rent has to be an asset. You've got about 5 seconds to get that corrected or get that in there. But this is one of those things. You have to be able to identify what kind of accounts are what. This is one of those basic things. Like if you're a doctor, you have to know basic anatomy. If you're in business, you need to know basically what accounts are what kind of accounts. Because if you're going to pay your rent 6 months in advance, what's that going to do to your income statement? Nothing. It's going to give you an asset until you use it. So, okay, so that is an asset. Okay, so when we went over those sample assets, sample liabilities, you need to be able to identify those for the rest of the semester, not just as, well, let's get ready for this test. Absolutely, you need it for the test, but you're going to need it the rest of the semester as well. Okay, so now this is that one that we just had a slide on it. Let's try it again. Okay, so unearned revenue. Keep talking about it over and over and over. What kind of account is unearned revenue? Unearned revenue. So this is unearned revenue is someone has paid me in advance for my services. So if I'm mowing lawns for a business, someone has handed me $600 in May to mow lawns in June, July, and August. So what is that $600 to me? What kind of account is that? That's unearned revenue. So what kind of account is unearned revenue? Okay, unearned revenue, so someone has given me money, so the money goes into cash, which is an asset. It's not an asset. Unearned revenue is a legal obligation I have to perform services or deliver goods, right? Because if you give me $600 to mow your lawn in June, July, or August, I now have a legal obligation, or I have a liability. So unearned revenue is going to be a liability. I'm going to close the question in about 5 seconds. Again, unearned revenue is a misnomer because you look at it and you go, ooh, revenue. It's not revenue. It's a liability until you actually perform the services. Okay, and one last question before we go on. You know that, write this down. Okay, a deferral is an adjustment for payment or receipt of cash in advance. Basically, is a deferral cash before the revenue and expense. So that slide where we had deferrals, depreciation, accruals, after deferrals, it says, does it say cash before revenue and expense? Really? Wow. Yeah, you asked too? Okay, well, I have it. I was looking going, 98% have it right. Okay. You guys ready now? You have an answer? How fast can you be? Okay, so deferral, is it cash before revenue or expense? Going back to that note, and that would be true. I'm going to close in 5 seconds here. Okay, so on to a homework problem. This is exercise 3.7. This just gives us a little exposure to adjusting entries. We're going to do 2 different ones. The first one, they're 2 separate adjusting entries, so they're not related. The first one, Paradise Travel, prepaid $6,000 for 6 months of rent. So right off the top of my head, I'm saying $6,000, 6 months of rent, that's $1,000 a month. So on October 1st, this company paid $6,000 for the next 6 months of rent. So now it wants the adjusting entry to record rent expense at October 31st. So when we make the original entry, when we pay that originally, we're going to debit an account called prepaid rent, and we're going to credit in cash, right? So we're paying prepaid rent. So we have this asset for $6,000 prepaid rent. Now what it's asking us to do is give the adjusting entry. So how do we recognize rent? We've had 1 month go by. So what we're going to see is we're going to debit rent expense for the 1 month of rent, the $1,000, and we're going to credit prepaid rent. Because what we want to do is we want to reduce that asset. So when we use up rent, we're going to have rent expense debited, we're going to credit prepaid rent, and what we'll see is the original balance, when we paid it originally, it's $6,000. So this is when we paid it originally, it goes into the asset called prepaid rent. When we recognize that we used, oops, not this one. Okay. When we credited prepaid rent, it went into the account, and then rent expense will be the debited. So what we end up with at the end of October is we end up with prepaid rent being only $5,000. That makes sense because we've used 1 month of rent. We still have 5 months left. So we have an asset for 5 months of rent left, and we have rent expense for 1 month. And this is at the end of October. So if we went into November, what we would see then is we would see that prepaid rent would go down another $1,000. So at the end of November, prepaid rent would be $4,000, and rent expense for the year would be $2,000. And that would just continue until we've used up all the rent. Now, rent is an account that it gets used up over time. So we can say to the rent, we can divide by the number of months, and we're good. But now we go on to the next adjusting entry, which is supplies. And supplies are not a function of time. Rent is a function of time. Supplies are not. When we buy supplies, we get supplies in and then we use them up. So supplies are a little bit different, and that's what we have in the second example. So on October 1st, the company paid $950 for supplies. So we paid $950 for supplies on October 1st. So we have this giant stack of supplies. So all during the month, we use supplies. Now when people go, these could be paper towels, it could be copy paper. We're not stopping every time we run and get supplies to write a journal entry for it, because that would really be slow things down in our business. So what we do instead is we say, okay, we know we had $950 at the beginning of the period. Now at the end of the period, we're going to do an inventory. So we're going to count what we have left. And it tells us in the problem that at the end of October, they have $270 in supplies left. So we had $950. We only have $270 now. So what we used is the difference between those two. We used the difference. So what we're going to do here is we'll have supplies expense for the difference between what we started with and what we ended with, because that's, how did it go down? It went down because we used it. And we'll credit supplies for the $680. And then if we're asked, well, we are asked for the account balances, what we'll see in supplies is we had a beginning balance of $950. It's on the debit side because when we purchased it, it's an asset, so it has a debit balance. And then we credited supplies in our adjusting entry, so to credit, take the difference between the debits and the credits in the T account, we get an ending balance of $270, which is actually what they told us the ending balance was, so we've done it right. And then supplies would have been debited. So we're just posting that entry there. So when we post the entry to the T account, we're taking the amounts in the entry. So the supplies expense is going down here to be debited, and then supplies is credited over here for the $680. Okay, so we've gone through adjusting entries, kind of hit the high points of them. Again, for other homework problems, I do have the videos posted. So next up, what we're going to do is the next step. The next step is, so we have gone through, we've done all our adjusting entries, we've posted the entries to the accounts, we've gotten account ending balances, and we've prepared an adjusted trial balance. So our next step is to prepare our financial statements. We did this in an earlier chapter, so I'm just going to do one statement here and then kind of give you an idea of what we're doing. So what they've done here in this exercise is they've given us a lot of account balances, and they're not in any order. They're just saying, here's account balances, and then they tell us that we need to prepare the income statement, the retained earnings, and balance sheet. So we're going to do the income statement just because it's a nice refresher of what we've done. So the first thing we'll do with the income statement is we put the name of the company, first line, always. The second line is always the name of the statement. And then the third line is the date line. The only statement that is of one particular date is a balance sheet. All the other ones, the income statement, the statement of retained earnings, and the statement of cash flows are for a period ending. Remember, too, that a trial balance is not a financial statement. We have 4 main financial statements. A trial balance is not one of them. It's used internally. So we have this income statement. So the first thing, income statement, a single-step income statement means that we don't put gross profit on it. We don't do a subtotal. So a single-step income statement, we're going to put our net revenues down, and our revenues we're going to get from the problem. Our revenues are given up here as $180,500. Then we're going to put our expenses. And in this problem, we have 2 expenses. We see we have cost of goods sold for $136,000, and we have all other expenses for $29,600. Okay, cost of goods sold is always first of the expenses. It's the big one. So cost of goods sold, and then all other expenses gives us net income. So we're going to take our revenues, sales revenues or revenues, subtract cost of goods sold, subtract all other expenses, and we get net income. Okay, now I want to tell you about an email I got a couple days ago from someone, and when this person was putting answers in my accounting lab, they would always put the $ in the comma, which are fine. My accounting lab doesn't care if you use $ or commas. I personally would not use $ because why do the extra effort? Because you can just type a number in, right? Sometimes commas help you keep the zeros apart, so that makes some sense. But what this person had done was had entered the number $space 100 whatever. It won't take spaces. Okay, you've got Excel doesn't like spaces in numbers, neither does my accounting lab. So just rule of thumb, when I would be entering numbers in my accounting lab, just use numbers and commas and decimal points. There's no need to go the extra effort to put in a $. $ is not wrong. It's just going to ignore it. But the danger is when you start inserting a space. Sometimes, too, I'll get emails from students that say, my answer's right, and what you don't see, but you can see on the back end, is you put a space in it. You know, so you typed your number, you've accidentally hit that space bar. So know that spaces don't work. But if you just use numbers, you're good. So it doesn't matter. I just personally wouldn't use $ because it's just more effort than you need, and it's not needed. Okay. So anyways, here's my income statement. Again, for the rest of that exercise, the various statements, that would be the recording. Okay, so then that brings us to the final step here. So we do our statements. We're at the end of the year. So we've gone through the whole year. We've recorded all our transactions. We've posted our transactions to the accounts. We did a trial balance to make sure our debits equaled our credits after we did the posting. Then we did our adjusting entries, and then we posted our adjusting entries. We got an adjusted trial balance. We did all our financial statements, and the final step says we need to get ready for next year. Now next year, what we're going to have to do is we have to close the books at the end of the year to get ready for, let's say, January 1, so the new year. So at the end of the year, whatever your year end is, you have to close some accounts. And the accounts that you have to close are the temporary accounts. Okay? Temporary accounts are revenues, expenses, and dividends. Absolutely. This is such an easy question to answer when I say what kind of accounts are closed. The answer is temporary or revenues, expenses, and dividends. Memorize that. RED, that acronym RED, revenues, expenses, dividends. Okay, let's say it's December 31st. So let's talk about this. December 31st, it's 11:59 p.m. So the clock strikes midnight. We have a cash account. Let's just do cash. Cash has $10,000 in it. So the clock strikes midnight on the first day of 2016. We still have $10,000 cash. It doesn't go away. Assets like cash are known as permanent accounts. So I don't have that written down here. But assets, liabilities, and equity, the balance sheet accounts, are permanent. They don't disappear. Your debts that you owe don't disappear at the stroke of midnight on a new year. So permanent accounts don't get closed. The only accounts that get closed are temporary accounts. So temporary accounts are revenues, expenses, and dividends. And let's talk about why. So let's say in 2015 your revenue was $500,000. So then 2016 in January, your January sales, are you going to say my revenues for 2016 are $500,000 plus more? No, you start over. Revenues start over with your own wages. When you say this is how much I earned this year, then you start the next year, you start over at zero, right? So some accounts start over at zero. Revenues, we need to set them back to zero for the new year. We need to set expenses back to zero for the new year. And dividends we need to clear out. When we're talking about dividends, we are talking about dividends we paid. If we got dividends from stock we own, that's called investment income or dividend income. But if you see the word dividends, it's dividends we paid. So there are three types of accounts. We need to start over at zero every year. And actually what we're doing is, remember we said retained earnings back a couple weeks ago. Retained earnings is this running total of all our revenues to date, less expenses, less dividends. That's what we do when we close the accounts. We're closing this red accounts, revenues, expenses, and dividends. So what we're going to do right now is this example is in the PowerPoint slides that you can download, but we're going to do the closing entries. Closing entries, if you remember red and then you know what normal balances are, you are golden, okay? So on that exam info sheet, it gives you normal account balance. What increases an account, that's its normal balance. What we were given here is a bunch of accounts. Okay, so what we're going to do is we're going to do closing entries. There are three closing entries, and they start with the letters red, right? Revenues, expenses, and dividends. So we're going to start with revenues. We're going to start by closing the revenue account. So all I've done is taken that table of information, moved it to the top of the screen. So revenue accounts are first. To close revenue accounts, we're going to find each revenue account. If we have more than one, I see service revenue. Now, revenues have a normal credit balance, right? And that's on that sheet, the exam info sheet. I know it has a normal credit balance, so I'm going to have to debit revenue. So I'm going to debit service revenue. If I have a credit balance of $63,800 and I debit $63,800 to that account, I have zero, which is what I want to start the year with. So I'm closing out. So I'm going to debit service revenue. I'm going to debit interest revenue. That's my other revenue account. So I've just looked through the list looking for any accounts that are revenues. So now those are my only two revenue accounts. I've debited them because they have a normal credit balance, and I want to wipe them out. So if they have a credit balance, if I debit them, they're zero. So then I'm going to credit retained earnings. So how did I get the credit for retained earnings? I added my two debits because every entry has to have equal debits and credits. So I add my service revenue, I add my interest revenue, and I get $64,600, and I'm going to close it to retained earnings. There's just a couple things you need to know about closing entries. Closing entries, you close the revenues, expenses, and dividends account. You close them with the opposite of what increases them. You want to decrease them. You want to decrease them to zero, so whatever decreases that kind of account is what you're going to do here. So we're going to decrease them. And every closing entry impacts retained earnings. So revenues, you wipe out revenues, and you have retained earnings. Now we're going to wipe out expenses next to retained earnings. And we're going to wipe out dividends to retained earnings. So I know that I have to debit my revenues because I'm wiping them out. I want to reduce them, and I'm going to credit retained earnings for that total. So that's the first entry. The second one is to close my expense accounts. Again, I'm going to look through the list for all my expenses. Now, expenses have a normal debit balance. So to decrease them, I need to credit them. So with my entry here, I'm going to skip a line, and I'm going to go down to my credit. So my first one, cost of services sold, that's an expense. You see, I skipped a line, I indented, and I credited it. Because expenses increase with debits, we're going to close them out with credits. So closing entries, we're getting them to zero. So I'm going to credit cost of services sold. I see selling, general, and administrative expenses for $12,800. I'm going to credit that as well. I'm going to credit every expense account I can find. I'm going to credit depreciation expense. And I'm going to credit income tax expense. So I've gone through to find all my expenses. Okay, so expenses, I'm going to credit every expense, and then I'm going to add those four things up. So I'm going to add $28,600, I'm going to add $12,800, I'm going to add $8,200, and I'm going to add $1,200. So I'm going to add those four things up, and I'm going to debit retained earnings for the total of those. So I got the $50,800 by adding the four credits up, because I know my debits have to equal my credits. So far, I've closed my revenues by debiting all my revenues, crediting retained earnings. I've closed my expenses by crediting my expenses, debiting retained earnings. Retained earnings is in every single closing entry. So then my last closing entry is the last part of red, revenues, expenses, dividends. So I'm going to close my dividend account next. My dividends have a normal debit balance, I know from looking on my sheet, so I'm going to want to credit dividends. So I'm going to indent, skip a line, indent, credit dividends because I want to wipe it out to zero, and then I'm going to debit retained earnings. Every closing entry impacts retained earnings. Now we said retained earnings increases with revenue, decreases with expense. It also, retained earnings increases with net income. So if I asked you what's net income for this company, we can calculate what net income is for this company by taking our revenues minus our expenses. And so our total revenues, $64,600, I can go back to my closing entry for what was credited to retained earnings. It was $64,600, those two accounts. What were my expenses? I can go back to my closing entry. Those four items I can add up. It was $50,800, so I would have expenses. So my net income is revenues minus expenses, so it would be $13,800. Dividends never, ever, ever impact net income. Dividends are considered a return of capital to the owners. Okay. So one last thing with this, what we see then with a T account for retained earnings is we have our beginning balance of retained earnings. This beginning balance was given to us in the problem, and it was a credit balance because the normal balance for retained earnings is a credit. So we have a credit balance of retained earnings. We credited revenues in our closing entry. We debited expenses in our closing entry. We debited dividends in our we debited retained earnings for the total of expenses in our closing entry. We debited retained earnings for the total of dividends. So now we draw a line. We add our debits up. We add our credits up. Take the difference, which is $18,400, and put it on the larger side. Okay, so that brings us to the end of this chapter, and what we're going to do now for the next 20 minutes is I still have one or two questions left. We'll do them towards the end because I think we'll have a little bit of extra time at the end. But what I want to do now is I want to open it up for questions about the exam. Before we get there, just a couple reminders. So here we are. Okay. So the exam is over chapters 1, 2, and 3. So all the material through this weekend that we've done in the class. The exam is Monday the 15th through Wednesday the 17th. You have to start it before 4 p.m. There is no class on the 15th or the 17th. Your job next week is to take the exam. Now, I've gotten a question from someone asked me last week about why, because you have a practice exam quiz, and this practice exam quiz is, you have a maximum of 5 attempts. I would absolutely do all 5 because it's going to be different each time. And somebody said, well, why do you use the average? And here's why. Because when I don't use the average, what people will do is they'll take an attempt, won't really try, submit it because they want to look at the answers, and then do it again and do it again, and only do it one time where they're really practicing. Accounting is the kind of field where you have to practice. So I need to make it so that you practice it. Just looking at the answers, I can make anything look easy until you have to do it. So if you're the kind of person where you're saying, but I don't want to impact my grade, I don't want to reduce my grade when I'm practicing, that's fine. Study plan is in my accounting lab. Study plan includes all of the material that is on the practice exam and virtually everything on the exam. And study plan does not impact the calculation of your grade at all. You can do all the looking and answering that you want in study plan. It will not impact anything. So if you want to practice before, that's fine, but take the practice exam. I would take the practice exam I would take it 5 times, I would, and I would practice it every time. Try for the highest grade every time. There is no time limit on the practice exam, okay? So you can take as long as you want. The practice exam is virtually the same as the exam. Your exam is in my accounting lab. Your exam is going to look and feel like the practice exam. So it won't be any surprises. It'll be different when you take it. It's not identical, but the problems, if you take the practice exam, let's say you play in study plan and practice, and then you take the practice exam 5 times and you're doing really well on it, this exam should not be a surprise to you at all. The practice exam is made to emulate an exam. There is no time limit on a practice exam. There is a time limit on the real exam of 2 hours. Most people will finish the real exam in about 45 minutes. That's a typical person. You may or may not be typical. There is no curve on the exam. Not going to happen. The average score on the first exam usually hovers around 69 or 70%, and I will have people get 100%. I can almost guarantee that we will see 100% in several, not just one. And the other thing that I do want to tell you, this affects potentially practice exam and the exam itself. Let's say either situation, because they're both in my accounting lab, they're both take a test or take a quiz. So let's say you're in the practice exam and your computer freezes, or you lose your Wi-Fi, or something weird happens. No worries. You need to restart. If it was a matter of freezing, you need to restart your computer. Restart your computer, go back into take a quiz, and when you take a quiz, it's going to look like one attempt is used. It hasn't been used until you actually submit it. So just go back into it, go take a quiz, and you will be back in that original attempt. That original attempt does not submit until you press the submit button or until time runs out, okay? So the same thing applies during an exam. Let's say you're taking the exam and worst case, it freezes and you're like, oh no, it's okay. Just restart and go back into it. Now the proctor will have to put the password back in. So you're going to have to get the proctor to put the password back in, but you'll be able to pick up pretty much where you left off. If you ever see a save button, that's probably nice to hit save occasionally. Not totally necessary. Usually you'll be back in. And the exam is structured so that you have two hours to to get it, and you should have adequate time. The big thing, I'm going to say one more thing, and then I'm going to take your question and other questions. And I see you answering exam questions for me, right? Wait, not yet. Hold on. I just see you typing a lot. So, okay. So the thing to remember, and then I'm going to open up for questions, is during the exam, if there is any issue during the exam, you need to email me after that exam, after you're done with the exam. Do not rely on the proctor to say, oh, well, I'll contact her. Because, of course, that'll be the one proctor that got busy after talking to you and went and did something and doesn't ever remember to notify me. This is your high-stakes exam. It's your worry, not theirs. So if there's any issue, you need to email me. Know that I'm monitoring emails. I'm absolutely watching it. And if something urgent, I'm going to get back to you as fast as I can. So the rule is, no matter where you take your exam, if something happens, you need to email me and let me know. If you're in sections 5 and 6, you need to make sure before after you submit your exam, because your exam at the end, there's a submit, and you click submit, and it says, are you really sure? And you hit submit, you hit yes. Well, once you do that, then ask ProctorU if you can close their window. Don't do that until after that. And once you hit submit, anywhere you are, your exam score will pop up. You will see your exam score immediately. Yeah. Okay, so I'm going to start with questions. So,
we started by 4 p.m. on Wednesday or 4 p.m. on any?
The exam has to be started by 4 p.m. on Wednesday. That's your last time. You're bound by like proctor hours, or if you're taking it in the computer lab, you have to start it by 7 p.m. on Monday and Tuesday because they close. You have to start, and that was it. Oh, one other thing. Yesterday, I emailed you. So a lot of people email me and say, what section am I in? Well, you don't really need to know at this point. I emailed you yesterday and said, you are taking your exam here. So you either got an email saying you're taking it in the computer lab or you're taking it online with ProctorU. That email was for you, for your section. Don't assume that was just for the whole class and it doesn't apply to you. If you got an email from me that says you are taking the exam in the computer lab, that's the only place your exam will open. If you got an email from me saying you're taking your exam with ProctorU, that is the only place your exam will open. Every semester I'll have a half a dozen people that are in the wrong place. But so your exam information is in Blackboard. I've emailed you. I'll probably email you one more time before the exam, but there we go. Okay, so now can I answer questions online? Okay. I'm not going to answer Dane's because I don't know what the backstory was on that one. Okay. Oh, those are all answered. Everyone's answering. No, that's fine. Okay. Okay, well they're fine. Okay, any more questions in person? Did you have a question or were you? Okay. Anyone else have questions? We do not have class next week. Yes. Yes, if you're taking it in the computer lab, and yes, if you know where room 200 is, where we are right now, it's the very other end of the hall, and there's a whole bunch of glass labs along the wall. It's like 224. There's proctors in it, and they'll get you situated. Okay, anyone else? There were a lot more questions at the 7:45 class. Anyone else? Yes.
I looked at the tutoring.
You're not available to go to any of the tutoring, like on Mondays?
Yeah, I have class all during this time.
Okay, Monday, I think, aren't there like 12 hours on Monday?
I only saw like it's usually like an hour.
Right, but Monday in Prentice Hall, I think there's a 12-hour time slot.
Okay.
So that's just a heads up. When you look on tutoring, there's like a 2-hour time slot every day, except Monday there's a huge tutoring slot. I think it's like 12 hours, I was thinking. Yeah. Okay, the question is what's provided, so I'm going to answer for both sections, even though I know you didn't ask for both sections. So if you're taking your exam in the computer lab, Well, no matter where you're taking your exam, you need official photo ID to bring with you. You need to bring a pencil or writing utensil too. But in the computer lab, they have a calculator for you to use, they have scratch paper for you to use, and they have the exam note sheet for you to use. If you're taking it online with ProctorU, you will have to have a simple calculator, a plain calculator without a memory, so you can't use like TI-83s or TI-89s. Just a simple calculator. If you take it online, you can have blank scratch paper, and then they will provide you a PDF of the exam reference sheet. So they have it. They have the exam reference sheet down in the computer lab, so you don't have to bring any of that. You can't bring any of that. What if the campus is closed on Wednesday? It won't be. Okay, so I'm not going to answer what if, you know, but no. First of all, okay, here's the deal. Do not wait till Wednesday to take your exam. Wednesday should be, the only reason you should take your exam Wednesday is because you had some huge crisis occur Tuesday. Take your exam Monday or Tuesday. If you do not start your exam by 4 p.m. on Wednesday, you have a 0 on this exam. It's just like if you were applying for something. In business, there are hard, fast deadlines. And if you don't get your estimate in, if you don't get your quotation in, if you don't meet the deadline, you're out of luck. Same here. You have till 4 p.m. Wednesday. What if we use the calculator on a computer? Autumn, you're talking about, you must be online. There is a calculator in my accounting lab. You cannot use a calculator on, you cannot use the calculator on your computer. How does what get decided? About Wednesday, snow days? Joshua, what do you mean random? So, Joshua, the campus will not be closed Wednesday. Whatever happens, I will make that decision and I will communicate it, but I will not, Macaulay, if you hate my accounting lab's calculator, just get a plain calculator. You can use a plain calculator with simple plus, minus, multiplication, division. So you don't have to use my accounting lab calculator, but you can use a plain one, but it's going to have to be a plain one without a memory. Okay. So, yeah. Okay. Anyone have any other questions? Okay, I have another question for you. For ProctorU, we print out the exam sheet. No, ProctorU will give you a PDF. You will have a PDF available for it online. Okay. Okay, let's see. Okay, stupid, can we bring our own calculator? Okay, can you bring your own calculator? Hold on, these are going too fast. Can you roll back up? Okay. Okay, the one above that. For ProctorU, we print out the exam sheet. No, that has to be PDF. Wait. Okay, this may seem stupid, but can we bring our own calculator? If you're taking it with ProctorU, you can use your own simple calculator. If you're taking it in the computer lab, you cannot bring your own calculator. They have a calculator for you to use. Is it ever possible that we can show the printed out exam note sheet? No, you have to use the PDF version. How many questions are on the exam? I don't know. I think there's 3 or 4 exercises in between 22 and 28 multiple choice. The practice exam is virtually identical in structure. So whatever you see on the practice exam, expect similar on the exam. Don't want to take the risk. We'll give the exam on Monday morning. So let's see. Okay. Yeah. Okay. Is there any time we can't do the exam, or will ProctorU be available 24/7? You have to schedule your exam with ProctorU ahead of time. They have time slots. They are 24/7. It depends when you sign up the availability, if the time slots are taken or not. So they are 24/7. They're, and sometimes slots filled up. I sent you out an email about a week ago saying you should sign up soon. So anyways, Yeah, and they do fill up. Okay, so now we have a question, and remember when you're answering this, so you've got to do two things for this question. First of all, it says which of the following accounts will be closed at the end of a period. So what kind of accounts are closed at the end of the period? Revenues, expenses, and dividends. So we have revenues, expenses, and dividends. So what you need to do is go through there and pick out which of those. There's only one. Out of those four accounts, there's only one of those that would be a revenue, expenses, or dividends, because the accounts we close are the red accounts, revenues, expenses, and dividends. Okay, about 80% of you are right at this moment. So, to answer this question again, you're looking for a revenue, an expense, or a dividend. The accounts that are not closed are the accounts that are found on a balance sheet. So the accounts that are not closed are going to be assets, liabilities, and stockholders' equity. So as we go through here, accounts receivable, what type of account is that? Anyone? Asset, yes, I heard it. So accounts receivable is an asset. It's not closed. Our only accounts that we close are revenues, expenses, and dividends. So the next one, what type of account is accounts payable? Liabilities, yes. So that probably isn't closed. Common stock, what kind of account? Equity account. Okay, so the only accounts we close are revenues and expenses and dividends. So we said this is not accounts receivable is an asset, accounts payable is a liability, common stock is in stockholders' equity account. So we have one answer left. Okay, I'm going to close this in about 5 seconds. Anyone in the room here have any questions? If you have them online, you can ask them here. Anybody question about the exam? We do not have class next week. And the other thing I should tell you is I'm going to a conference Friday through Sunday. I will be available via email, and I'm pretty obsessive about checking email during any time, but especially during an exam. So if there's any questions you have or anything, please feel free to email me. I will email you again, but I want you to know good luck on the exam, and then I will see you in a week. Okay?